Imagine walking up to a roulette table, right? You put down 10 bucks and you just casually ask the casino manager to multiply your bet by 1,000.
Yeah, you'd be laughed right out of the building by security.
Exactly. They would physically throw you out.
Yeah.
But today, for you listening, we're looking at a platform where that exact seemingly insane scenario is, well, it's just mathematically baked into the code. Welcome to today's deep dive.
Thanks for having me. I mean, we really are looking at a complete structural redesign of how a market operates here.
Yeah.
Because in any field, there are these established best practices that everyone just assumes are like the laws of physics.
Right. The things you just don't question.
Exactly. But the most disruptive innovations usually happen when someone looks at those best practices,
Yeah.
analyzes why they exist, and then just decides to build a system that does the exact opposite.
Which brings us to the source document for today's deep dive. We're unpacking a project called LeverUp. It's built on the Monad ecosystem, and it is systematically tearing up the traditional rulebook of decentralized finance trading, or DeFi. Tearing it up and throwing it away.
Truly. And whether you're a hardened crypto veteran who's been navigating these markets for years, or you're just, insanely curious about how financial systems are being re-engineered behind the scenes, we're going to break down how LeverUp achieves things that really shouldn't be technically possible.
Like offering 1,001x leverage.
Exactly. We're talking 1001x leverage, and doing it without the very foundation that the rest of the industry relies on. It's wild.
It is wild. And to really grasp how radical this is, we first have to define what kind of platform we're actually talking about here.
Okay, set the stage for us.
So LeverUp is a decentralized exchange, a DEX, and it specializes in perpetual contracts.
Let's actually pause and define that for a second, just because financial jargon can get so dense so quickly.
Oh, for sure.
So in traditional finance, if you buy a futures contract on something like crude oil, it have a hard expiration date. When that date hits, you either have to sell the contract or physically take delivery of barrels of oil.
Right, which most people don't want to do. Nobody wants a truck of oil in their driveway. But a perpetual contract, on the other hand, never expires. It allows a trader to speculate on the price movement of an asset indefinitely, just holding that position open for as long as they maintain the required margin.
Exactly. And in the current landscape of DeFi, platforms that offer these perpetual contracts, places like GMX or DYDX, which our source specifically points to, they all run on one foundational mechanic.
Right.
They require liquidity providers.
The LPs. These are the people or institutions who park their own capital into a central smart contract pool, right? So that traders actually have someone to trade against.
Spot on. That pool of capital acts as the counterparty. But there is a massive inherent flaw with that traditional model.
Okay, what is it?
The size of that liquidity pool, which the industry calls total value locked, or TVL, it strictly dictates the absolute limits of the entire exchange.
Ah, I see.
Creates this hard, unyielding ceiling. The TVL decides how deep the market is, how liquid the assets are, and ultimately, it caps the maximum position size that any individual trader can open.
It's like a grocery store's inventory, right? If the store only has 10 apples in the back room, you cannot walk in and buy 50 apples.
Right.
It doesn't matter how much cash you have in your pocket. The system literally cannot support a transaction that exceeds its physical reserves.
That's a great analogy. So these traditional exchanges are locked in this constant, desperate tug of war to attract and retain liquidity providers.
Because without them, the store is empty.
Exactly. They have to constantly offer higher yields and better incentives just to keep that capital from fleeing to a competitor. Well, LeverUp looked at that entire architectural struggle and decided to just remove the liquidity providers entirely.
Wait, they just deleted the middleman.
Completely.
But wait, let me push back on this a little bit, because the casino analogy from earlier only goes so far. A physical casino has actual cash sitting in a physical vault to pay you if you hit a massive jackpot.
True.
So if there are no liquidity providers depositing capital into a pool, and I open a massive trade and win, where does the payout actually come from?
That's the million-dollar question.
Right. Does the protocol just mint its own money out of thin air? How does that not just immediately collapse the entire system?
And that is the core vulnerability of any synthetic market. But the source outlines how LeverUp mitigates it. And it's pretty clever. They don't just print money wildly.
Okay, good.
Instead, the protocol itself acts as the counterparty, utilizing what they call an uncapped open interest model.
Uncapped open interest. What does that look like in practice?
Well, in a high-volume perpetual market, you constantly have traders taking opposing sides, right? Some are betting the price will go up, others are betting it will go down.
So you're at longs and shorts.
Exactly.
Yeah.
So the protocol essentially acts as a dynamic balancing scale, netting those long and short positions against each other in real time.
Oh, I see. So the platform is using the collective flow of the market to balance the books rather than relying on like a static pool of parked capital.
That's exactly it.
Yeah.
And because they aren't constrained by that static pool, that arbitrary TVL ceiling we talked about just disappears. Traders finally have the freedom to execute the exact strategies they want at the massive scale they want without suddenly hitting a liquidity wall.
Okay, I definitely see the massive appeal for a trader who needs to move serious volume. But if we follow the money here, in the traditional model, those liquidity providers are putting their money in the pool to collect a cut of the trading fees, right?
Right.
If LeverUp has no LPs to pay out, where is all that fee revenue going? Who gets the money?
The source reveals a really fascinating piece of business logic here. LeverUp takes 100% of the protocol trading fees and returns them directly to the traders.
Wait, what? They rebate every single cent.
Entirely. The users getting charged the fee are simultaneously getting it fully refunded.
I mean, I have to challenge the basic business mechanics of that.
Go for it.
If you are operating a highly complex, decentralized platform, taking on the massive risk of acting as the central counterparty, and you are voluntarily giving all of your transactional revenue back to the users,
It sounds crazy, I know.
you're operating at a fundamental loss. How does the protocol even survive?
Well, if you analyze it purely as a traditional rent-seeking business, yeah, it looks disastrous. But LeverUp is playing a much longer systemic game here.
Okay, explain that.
They are utilizing what's known as the volume-first playbook. They are deliberately trading short-term fee revenue for aggressive user retention, powerful word-of-mouth marketing, and above all, staggering trading volume.
So they are trying to build an undeniable network effect.
Precisely. The source actually draws a direct parallel to early Uniswap to explain this.
Oh, the classic Uniswap model.
Right. In the early days of DeFi, the key to building a dominant protocol wasn't to instantly extract a toll from every single user. The goal was to become the absolute center of gravity for the market.
Get everyone in the door.
Yeah. If you create an environment where trading is virtually frictionless because the fees are essentially zeroed out by rebates, traders have absolutely zero incentive to go to a competitor.
That makes a lot of sense, actually. The profit isn't in charging a toll at the bridge. The profit is in owning the real estate surrounding the bridge. And your entire goal is to get as much traffic to drive through your city as possible.
That is a perfect way to look at it.
Because in the crypto world, a hyperactive, massively adopted ecosystem naturally drives up the intrinsic value of the protocol's underlying token.
Exactly. The overall ecosystem value supersedes the direct day-to-day revenue model.
But dealing with all of that traffic introduces a completely different technical hurdle, doesn't it?
Oh, definitely.
I mean, if they're succeeding and everyone is flooding the network to trade, wouldn't the gas fees from constantly moving external stablecoins around, like USDC or Tether, wouldn't that completely crush a high-frequency system like this?
It absolutely would.
Every time a smart contract interacts with an external token, it costs computational energy.
Yeah.
Is that why the source mentions they built their own internal stablecoin?
You've hit on the exact bottleneck they're bypassing. Their native stablecoin is called LVUSD.
Okay, LVUSD.
Right. When a platform relies entirely on external stablecoins, every settlement, every margin adjustment, every single fee rebate, it all has to interact with a centralized issuer's smart contract.
Which slows everything down.
It creates massive friction. By handling all in-chain settlement natively with their own LVUSD, LeverUp keeps the kinetic energy entirely inside their own closed-loop system.
Ah, so it improves the capital efficiency and insulates them from, like, external network congestion.
Exactly.
So let's look at what we have so far. We have an ecosystem custom built for absolute maximum throughput. You have uncapped liquidity. Traders are getting 100% of their fees rebated. And you have this highly efficient internal settlement layer.
It's a powerhouse.
It's a playground designed to encourage trading on a massive scale, which leads us to the elephant in the room, the jaw-dropping statistic in our source material today.
Here we go, the leverage limits.
Yes. For you listening, just to ground this concept really quickly, leverage is when you borrow funds to multiply your buying power. It multiplies your potential gains, but it ruthlessly multiplies your potential losses. In traditional stock markets, using 2x or 3x leverage is considered aggressive.
Very aggressive.
In the crypto Wild West, 100x leverage is a known, albeit highly dangerous standard, but LeverUp allows traders to use up to 1001x leverage.
It is a staggering leap in scale, truly.
I mean, I have to step in as the voice of sanity here.
Please do.
1001x leverage sounds less like a financial instrument and more like, I don't know, financial base jumping without a parachute.
It's terrifying on paper.
At 1001x, if the underlying asset price moves against your position by even a tiny fraction of 0.1%, your entire margin is obliterated. You are instantly liquidated. Why would any rational system offer that level of exposure?
It is undeniably extreme. But to understand its presence, we have to look at how it is actually applied in practice.
Okay.
1001x is the theoretical ceiling of the platform's capacity. It is basically a flex of their architectural muscle, demonstrating the absolute upper limit of what their smart contracts can sustain.
So it's not for everyday use?
No, not at all. It isn't meant to be the default setting for a casual retail trader just throwing a few dollars around on a Friday afternoon.
It's like an automotive manufacturer putting a speedometer in a hypercar that goes up to 300 miles per hour, right?
Exactly.
You are never going to drive that fast on your way to the grocery store, but the engine is engineered to handle the stress.
That's exactly it. And you cannot build an engine capable of those speeds without an incredibly sophisticated braking system.
That makes sense.
So LeverUp relies on what the source describes as an institutional-grade risk engine.
Okay, what does that actually look like under the hood? Because we established earlier that the protocol itself is the counterparty.
Right.
If a trader takes a massive swing at 1001x leverage and the market moves against them, the protocol takes a devastating financial hit if it doesn't close that position out in time.
Correct. The protocol is on the hook. So the risk engine operates as this ruthless, fully automated sentinel.
A sentinel.
Yeah, it is constantly monitoring the health and margin requirements of every single open position on the platform simultaneously.
Wow.
When a position crosses the liquidation threshold, which, as you mentioned, at 1001x leverage, happens in milliseconds.
Literally the blink of an eye.
Exactly. The engine must instantly execute the liquidation and close the trade before the trader's loss can spread to the protocol's own balance sheet.
Which brings us to a massive technological dependency. You cannot run a risk engine that operates in milliseconds on a traditional sequential blockchain.
Not a chance.
Trying to execute thousands of complex liquidations on an older network would be like trying to run a high-frequency trading firm using a single-lane checkout at a grocery store.
Yeah, everyone is just stuck waiting in line while the market is crashing around them. It's a disaster.
So how do they solve that?
That single-lane bottleneck is exactly why LeverUp is built specifically on the Monad ecosystem.
Ah, Monad.
Yes. Monad is fundamentally designed around parallel execution.
So instead of one cashier trying to ring up every single transaction one by one, Monad provides like 100 automated lanes processing items simultaneously.
Exactly. That massive throughput and ultra-low latency are what make the complex mathematics of an institutional risk engine self-consistent.
It's the only way the math works.
Right. The blockchain has to be fast enough to read the Oracle price, calculate the margin, trigger the liquidation, and settle the LVUSD internally, all in a fraction of a second. Monad is the enabling infrastructure here.
So the infrastructure is specifically tuned for extreme speed. And that tells us a lot about who this platform is actually built for, doesn't it?
It does.
The source makes it clear that LeverUp is aimed squarely at professional traders, quantitative funds, and institutional players.
Right. Because for a professional, extreme leverage isn't a gamble.
It's a tool.
Exactly. It's a highly calibrated tool used for hedging and complex arbitrage. And a major draw for that specific institutional crowd is LeverUp's integration of real-world assets, or RWAs, alongside traditional crypto assets.
Let's unpack that for a second. We are talking about tokenized versions of traditional stocks, global commodities, and foreign exchange markets being traded natively on the blockchain, right?
Yes. All in one place.
So the ability for a quantitative fund to sit on a single decentralized platform and execute a highly leveraged trade on Bitcoin, and then instantly hedge that exposure with a tokenized traditional equity position.
It's massive.
That is a massive operational advantage. It unifies historically fragmented global markets under one frictionless, uncapped roof.
It really is a game changer for pros.
I understand the appeal for a quantitative fund looking for efficiency. I really do. But there is a massive looming shadow hanging over this entire conversation.
I think I know where you're going with this.
When we talk about a centralized entity or even a decentralized protocol acting as a central counterparty offering 1001x leverage, it sounds terrifyingly similar to the exact kind of opaque recklessness that blew up major centralized exchanges in the recent past.
Yeah, the source document directly references the collapse of FTX as context for this, and for good reason.
Right.
The entire industry is currently suffering from a massive trust deficit.
Huge.
The fundamental flaw with centralized platforms is that they operate as complete black boxes. As a user, you have absolutely no way of knowing if the exchange is secretly trading against your own positions.
Or if they're manipulating their internal order books to trigger your liquidations early.
Exactly. Or if the fee flows are actually going where they claim they're going, you are forced to just blindly trust the operators.
So how does LeverUp counteract that deeply ingrained skepticism? I mean, if I'm a professional trader moving millions of dollars of institutional capital, I need to know the parachute is packed correctly before I jump off the cliff.
Their countermeasure is radical.
Wow.
100% on-chain transparency.
100%.
Every single metric of the platform is recorded immutably on the Monad blockchain.
Wow.
The open positions, the fee rebates, the exact liquidation triggers of the risk engine, the internal flow of the LVUSD stablecoin, it is all public.
Yes.
Anyone can verify the data in real time.
So the transparency isn't just some philosophical ideal meant to appease crypto purists.
Not at all.
It is the core functional feature of the platform. They are substituting blind trust with verifiable cryptographic truth to counterbalance the terrifying risks associated with 1001x leverage.
Well said.
If you're going to invite people to base jump, you have to let them inspect every single thread of the parachute.
Exactly. Transparency is the only mechanism available to mathematically prove that the house isn't cheating.
Let's pull all of these complex threads together for you listening, because we have covered a massive amount of architectural ground today.
We really have.
We're looking at LeverUp, a platform utilizing the parallel processing power of the Monad blockchain to completely rewrite the rules of DeFi.
Right.
They've eliminated liquidity providers entirely, meaning traders interact directly with the protocol through uncapped open interest. They are returning 100% of all trading fees to prioritize massive volume and establish a dominant network effect.
And don't forget the stablecoin.
Right. They've insulated their system from external friction by settling everything internally with their LVUSD token. They're offering up to 1001x leverage across both crypto and real-world assets, protected by a lightning-fast institutional risk engine. And, to top it off, they are proving the integrity of the entire system with absolute on-chain transparency.
It is a remarkable synthesis of financial engineering and blockchain capability.
It really is.
However, I think it's vital to reiterate the blunt advice provided by our source material today.
Yes, please do.
While the mechanics of this platform are incredibly imaginative, and LeverUp could very well become a vital piece of core infrastructure on Monad, regular users should stay far, far away from actually trying to use 1001x leverage.
Look, but absolutely do not touch.
Exactly.
You can admire the engineering of the roller coaster from the ground, but do not strap yourself into the front seat unless you are a trained professional who fully understands the math.
It's a fascinating experiment in market structure, but the financial risks of extreme leverage are just unforgiving.
Which brings us to the end of today's deep dive. But we want to leave you with a final provocative thought to mull over.
Sure.
We started this conversation by talking about golden rules and how the traditional user-funded liquidity pool has been the absolute bedrock of decentralized finance up until this point.
It's how the entire industry was built.
It has been the unquestioned foundation of every major decentralized exchange.
Yeah, without doubt.
But if LeverUp's model proves to be robust over the long term, if a protocol can successfully act as an infinite, transparent counterparty without needing to constantly bribe a single liquidity provider to fund its operations.
Then what happens to the LPs?
Exactly. Does this mean the traditional liquidity pool is destined to become a relic of early DeFi? Are we watching the beginning of the end for the LP?
It's a massive question.
It really is something to think about the next time you see an industry strictly adhering to the established rulebook. Thanks for joining us on this deep dive.